Welcome to the Explainer. Today, we're unpacking a really interesting one, ONEOK. Is it a fairly valued pipeline giant or a long-term dividend compounder? We're going to strip away the noise and look strictly at the fundamentals, the intrinsic value, and the hard data to see if this midstream energy network has the right ingredients for your portfolio. Let's dive right in.
Here's our roadmap for today. We'll start with the business and intrinsic value, do a deep dive analysis, look at the SWOT and scenario models, target your exact buy prices, weigh the risk versus opportunity, and wrap up with our final verdict.
Okay, kicking things off with Section 1, Business and Intrinsic Value. So what exactly does ONEOK do? Well, to put it simply, you can think of them as a giant energy toll road operator. Unlike upstream oil and gas producers who basically live and die by super volatile commodity prices, ONEOK earns largely fee-based revenue. They're out there transporting, processing, storing, and fractionating natural gas across major shale basins. It's a simple, sustainable business model. It acts just like a toll road, benefiting from incredibly long-lived assets, extremely high replacement costs, and highly predictable cash flow. Now, let's talk numbers. Our discounted cash flow model yields an $82 value, and the multiple expansion value comes in at $92. Blend those together, and you get an intrinsic value of $87 per share. But the real secret hiding right here is that PEG ratio of 0.41. You see, a traditional price-to-earnings ratio just doesn't tell the whole story with a stock like this. The PEG factors in the company's nearly 5% forward dividend yield. So the valuation actually becomes much more attractive once you realize just how much of your total return is driven by that steady dividend payout. But here's the catch. Take a look at the current market price compared to our value. This brilliantly illustrates why the margin of safety is incredibly thin right now. With the stock trading at $87.79, it's literally pennies away from our calculated fair value of $87. The market has absolutely priced in the stability of their cash flow.
Moving right along to Section 2, the deep dive analysis. Let's look under the hood.
So ONEOK possesses a massive infrastructure moat. I mean, think about it. Building a pipeline costs billions of dollars, and the environmental permitting alone can take years. This means the moat is nearly impossible for new competitors to replicate. On top of that, management has driven some seriously strong profitability. We're looking at operating margins sitting near a very respectable 15% and return on equity at an attractive 15.9%. Management has hit the nail on the head with execution, expanding scale and diversifying cash flow through some recent acquisitions. But, and this is a big but, those acquisitions definitely came at a cost. The crucial point here is the staggering $33.7 billion debt load. To put that into perspective, their debt-to-equity ratio is near 150%. This sits alongside incredibly tight liquidity. Their cash on hand is only $172 million, giving them a current ratio of just 0.71. In an era of higher interest rates, which, by the way, has already pushed their interest expenses up to $1.78 billion recently, this kind of leverage requires extremely careful monitoring. And that debt load brings us to the reality of their cash flow. While operating cash flow is incredibly strong and stable at $5.6 billion, infrastructure businesses require constant, heavy investment. Capital expenditures absorb over $3.3 billion of that pie. Because they have to spend so much maintaining these pipes and servicing that debt, the actual cash left over for owners, the levered free cash flow, is surprisingly thin at just $454 million, especially relative to a market cap over $50 billion. This really frames both the mispricing thesis and the long-term outlook. The market absolutely loves the stable dividends, but is actively discounting the stock because of that leverage and a somewhat moderate growth outlook. Future success here heavily relies on management gradually deleveraging that balance sheet.
All right, let's stress test this thing in Section 3, SWOT and scenario analysis.
We never rely on just one number, right? Depending on macroeconomic factors like recession fears, energy demand, and interest rates, the intrinsic value swings pretty dramatically. In a bear case, where we see recessionary weakness and multiple compression, the value drops to $62. Our base case assumes steady mid-single-digit growth and gradual deleveraging, landing right at that $87 mark. But in a bull case, driven by strong liquefied natural gas demand and lower rates, the value could expand all the way up to $112.
When we run a weighted SWOT analysis, ONEOK earns a total score of 6.5 out of 10. Notice how it's heavily supported by top-tier scores in its infrastructure moat, stable cash flow, and dividend attractiveness.
But look down at the bottom row. It's dragged down significantly by that high leverage, scoring just a 4 out of 10 there, along with some moderate scores in regulatory and acquisition risks.
Now for the fun part. Section 4, targeting your buy price. Let's look at the exact math. This shows the maximum price you can pay today to hit specific annualized return targets over a 16-year horizon. If you're an aggressive investor aiming for a market-beating 10% annualized return, you need to demand a massive discount to fair value and hold out for a $64 entry point. But if you're perfectly happy with a 7% return, which leans heavily on that current dividend, you could technically buy it at $85. Now, let's flip the script, because this is fascinating. What if you have a strict 9% return target, but different holding periods? If you have a shorter timeline, say 5 years, you have to buy even lower at $60 to hit your goal. Why? Because you have less time for the dividend compounding and earnings growth to do the heavy lifting for you. Conversely, if you can hold for 16 years, you can afford to pay up to $70 and still hit that exact same 9% target.
This brings us to Section 5, Risk versus Opportunity. What are you actually taking on by owning this? Well, our calculated risk score comes in at 6.3 out of 10. This tells us ONEOK is inherently safer than upstream energy producers, the folks actually drilling for oil and gas, thanks to ONEOK's fee-based model. However, it is inherently riskier than your standard regulated utility company because its earnings are still tied somewhat to cyclical energy volumes and regulatory risks. Basically, it's a moderate risk play.
On the flip side, the opportunity score edges higher, coming in at 7.1 out of 10. This is driven by excellent unit economics and a really durable competitive advantage. The long-term demand for natural gas infrastructure, especially with massive trends like LNG exports and power generation, gives this company a very solid baseline for continued growth and dividend sustainability.
Okay, let's bring it all home in Section 6, Final Verdict and Takeaways. So, what's the final verdict from the investment committee? Honestly, ONEOK is a high-quality operator with a really attractive dividend. It is a strong long-term dividend compounder, for sure. But because it's fairly valued right now with a paper-thin margin of safety, investors seeking outsized returns should probably hold at current levels. You really want to wait for a market correction or a sector sell-off to buy aggressively below that $70 to $72 range. And hey, if you already own it, the numbers suggest you might want to start trimming your position if the price euphorically pushes above $105 without any matching fundamental earnings growth. That wraps up our explainer on ONEOK, but it leaves us with one pretty massive, provocative question. Will its impenetrable toll road moat be enough to safely carry that staggering $33 billion debt load into the future? I would absolutely love to hear your thoughts on this. And now it's your turn. Drop a comment below and let me know which company's financials you want me to tear down in our next explainer. See you next time.